this digital age, headlines and market updates are constantly flashing across our screens, and it's not always clear what stories should steer our financial decisions. To help us navigate the noise, we're joined by Peter Sashecki from Everything Financial. Good morning, Peter. Good to see you.
Good morning, Carrie.
Okay, so
Nice
we know this as, we cover the news here, and right now inflation and ongoing tariff threats are dominating headlines and understandably causing major concern for many Canadians. How can people keep track of these big issues without getting caught up in the stress of the constant coverage?
Ignore the big issues. Sorry to be so blunt. It's really comes down to that, because these big issues, which are great for headlines and sensationalism, but they manipulate people's emotions. And when your emotions get manipulated, you make poor financial decisions. And if you're looking at long-term investing, which you should be, a daily news headline or a tweet or whatever the case may be, isn't how you manage your retirement plan or your long-term financial plans.
Now, as someone who works in the news business, I would say that it's always good for people to be informed in what's going on in their world. There are, as you mentioned, some emotions that can be stirred up and they can impact decision making. So what kind of strategies should investors use to try to stay focused on their long-term plan?
Work on a long-term goal and look at a 5-year. You always should be looking, for the most part, until you get closer to retirement, but you should be looking at the 5-year history of the portfolio that the company has you managed in. And an example, you said it in the headlines about the tariffs. When the potential news for tariffs came out, people literally lost their minds with their investments, not realizing that 90% of what was involved in most cases wouldn't actually, and didn't in the end, affect their investments, because your investments, depending on how the portfolio management company or the mutual fund company is managing them, is not tied to a news cycle. It's tied to proper strategies, the proper picking of different companies that integrate with each other, not what's going on in the day-to-day news, but what's going on in the long-term history of those companies. That's really what they're looking at.
So when we see stock markets moving up or down, how much should that influence someone's personal portfolio?
It shouldn't at all, because for one, when you see the stock market move up or down, if you react to that, you're already a day late and a dollar short, as they say. You've already missed the opportunity by watching that. Also, when you see news of the Dow Jones or the S&P or the TSX, that's a bundle of a whole bunch of companies that go into the rating on that particular day, like you're showing right now on the screen. But you may not even own the majority of those companies involved in that. Like if you have a well-balanced portfolio and you see the TSX do whatever, up, down, whatever the case may be, you may only have 30% of your portfolio in the TSX, not your entire portfolio in the TSX. You may have bonds, US, international, a whole bunch of other items in your portfolio. So you can't depend on, and you can't measure your portfolio, good or bad, by what you see on the news.
You kind of touched on this, Peter, but a lot of people wonder if they should try to time the market based on what they read or see in the news. Why is that a risky approach?
No, timing the market just doesn't work. You're late. Even like we talked about ETF funds, exchange traded funds, which follow the market. But again, they're making a reaction or a following of the market, so they're always late. Go with a strategy that fits your risk level. The lower risk you can take, just based on what you need for a rate of return, the more accurate that portfolio will be. There's going to be variation for sure, but there's less volatility. Less risk means less volatility, means more accurate rate of return. And timing, just trying to time the market just doesn't work, because I can tell you this, Carrie, my rear view mirror on investing is never wrong. I can tell you exactly what the market did 6 months ago. Can I tell you what it's going to do 6 hours from now? No. But ask me in 6 months and I'll tell you. And that is where timing comes in. You just can't time it right, because you never know till way down the road what was the best day to sell or what was the best day to buy. You're always going to be late. And unless you're extremely lucky and fortunate, you might get it right once in a while, but for the most part, you're going to you're not going to get it right.
All right. Well, good information this morning. Peter Sashecki with Everything Financial. Thanks, Peter. Have a great Wednesday.
Thanks, Carrie. Nice to see you.